UCO Bank reported what looked like a slightly weak set of numbers if you look at it sequentially. Net profit declined 61% quarter on quarter, though it is about 80% higher on a yearly basis. Slippages remain slightly elevated. Deposit momentum remains a bit soft. To discuss the bank's performance and the outlook going forward, we have with us the Managing Director and CEO Ashwani Kumar. Mr. Kumar, thank you very much for joining in. First, let's get your sense on asset quality. This slight rise in slippages, how do you view it, and what would be your forecast as we look at the coming quarters in the year?
Thank you for having me on the show. First of all, let me tell you that our slippage ratio during the last financial year was 1.75%. Sequentially, slippage ratio is coming down. And during first quarter, on an average, slippages are a little bit elevated. But during this current quarter, our slippages were in line with the previous quarter generally. And going forward, our intention and our entire effort is to keep the slippage ratio within 1 to 1.25% going forward in the full financial year.
In Q1, your slippage ratio was 1.35%, and you want to bring it down between 1 to 1.25%, right?
Yes, exactly.
Okay.
Yes, exactly for the full financial year. And yeah, please.
Go ahead. And also, if you could tell us any guidance on the gross NPAs, how much of your restructured book could fall into as NPAs?
See, restructured book outstanding on the count of the COVID restructuring is around 2,700 crore, which is coming down on a quarter-to-quarter basis. And going forward, it will further come down because on account of payments regularly we are getting on a quarter-to-quarter basis. And out of the restructured book, we have already provided for provisions as per the RBI guidelines. And in addition to that, around 530 crore additional provision we have kept as a forward-looking provision on the restructured book also.
Okay, got that. Mr. Kumar, thanks for joining us. If you can tell us about your deposit momentum, it was a little bit soft this time around. If you look at it, sequentially, it's absolutely flat. Can you tell us what happened on that front and how do you expect it to move from here as well?
See, if you look at our CD ratio has improved to 65%, which was around 59% a year ago. So we have a good amount of scope available to raise our CD ratio to 75% even without going for deposit in a big way. Currently, we are not going on account of increased rate of interest in a big way to garner the deposits. We have excess SLR of 8% available. So whenever there is a requirement, we can go to the TREPS market and borrow against the SLR securities as well. So on the deposit front, our focus will be on CASA mainly, where we intend to grow our saving account portfolio, current account portfolio, and retail term deposit instead of going for the bulk deposit. So in order to contain, we are not going for a high cost deposit currently, as we have ample liquidity also available.
Is there a CASA target you have in mind, sir? You are at 38% roughly CASA now. Since that's the route you're taking to keep your cost of funds under check as well, is there a target?
Yeah. Yes. So internally we have kept the target to reach to 40% level, though I know that in the current environment when the differential in the saving rate and the FD rate is high, so it will be very tough for the challenge for the team to keep it to bring it to 40. But our endeavor by bringing additional products in the saving portfolio to make it to 40% in the times to come.
Got it, sir. So now that's obviously the intention. But in the interim, as you mentioned that, there is pressure and obviously, term deposit rates have inched higher. Right now, you've been able to protect your margin. A lot of banks have already started showing a bit of a margin compression, but that's not happened with UCO. What's the forecast for Q2, Q3 onwards?
See, our net interest margin, we intend to make it to 2.90 to 3%. In the times to come, we are at 2.86% globally, and our intention will be to bring it to 2.90 to 3%.
Okay. So could you talk a little bit about loan growth? Where is it that you're seeing demand? Is there a loan growth guidance that you have in mind?
See, loan growth currently it is as you look at our mix, our RAM is retail agri MSME portfolio is 61%, and corporate portfolio is around 39%. So we intend to continue to maintain the same mix going forward. As far as retail is concerned, within the retail, housing loan and vehicle loan, personal loan, we will have three focus areas where the risk spread will be better and the yield will also be high. And corporate, we will be little bit choosy because corporates are not giving good yield. So they are very demanding and the yield on the corporate advances are low. So we intend to go very selectively in the corporate book, but we intend to grow along with that RAM portfolio so that we continue to maintain the mix also.
Okay, so very quickly, just to go back to the asset quality point, you managed to improve your GNPA ratio to 4.48%. Can you just give us one more number? What was the write-offs this time around? And also this restructured... Yes, sir.
Write-off was around 600 crore, around 600 crore. This quarter.
600 crores was write-off. What's the forecast? I mean, because you've also bumped up provisions in a big way, are you expecting a large part of your slippages to actually, you falter? The restructured book, are you expecting a large part of that to, come under NPA as well? Is that the reason you have preemptively built up your provision buffers?
See, if you look at my restructured book and the slippage out of the restructured book, it is around 10% of slippage out of the restructured book. And restructured book is currently at 2,700 crore on the count of COVID-19. And going forward, quarter on quarter, as we've seen the trend, the restructured book NPA is coming down. And overall NPA is mainly on account of MSME portfolio. And the provisioning which we have bumped up is on account of the forward-looking provisioning in keeping in view the ACL framework which is likely to come in a year or so. So on the standard book, we have made a provision on standard SMA 1 and 2, more than 1 crore portfolio is around 2,000 crore only. So standard 1 and SMA 1 and 2 is 2,000 crore. So that includes our restructured SMA as well. So there is not likely to be any big shock from the restructured book at least.
Got it. I think that explains it, sir. ECL. So you were already, building forward the rollout of that regime, expected credit loss, where of course the way banks account for NPAs will be very, very different. So thank you for that. That explains why your provisions are higher this time around. We will take a break on that note. On the other side.